Hi there, Etoro. It is Monday, the 26th of September, and that means it's time to take a look at what moved the markets last week. It was another rough week for equities and actually for many other assets outside of equities. So we can see on the NSDQ100, for example, this bit highlighted over here, we can see that stocks from Friday until Friday last week, the index fell about 4.5%. So that's extending a 2-week decline now after that little bear market rally that we saw. A similar thing can be seen within the SP500. The CSI300, so Chinese equities, not faring much better. And actually, I'm not going to do a deeper dive on Chinese equities this week because not much has changed. The economic outlook seems to still be pretty poor for the reasons that I've mentioned for the past few weeks running. And one of the largest stories from last week has to be the dollar. So the Dixie running to new highs just about every single week at the moment, setting new 20-year records. And this is already creating some pain. And if it continues to stay this high, I think that we could start seeing a lot of economic trouble around the world, as well as inside of the US. In terms of the causes for the price action that you see on screen, well, there were quite a few things happening, but it has to be this Fed's interest rate decision item that caused a lot of the trouble that we saw last week and the subsequent press conference. The Fed raised rates by the expected amount, so 75 basis points, 0.75%. I don't think that was the real issue. The challenge was in what the Fed chair spoke about after that. So there were lots of very hawkish statements about the fact that a soft landing is looking a lot less likely now, that the Fed was going to continue to push to try and weaken economic activity, that being the number of people in employment, activity within the housing markets, etc. So incredibly hawkish statements coming out of the Fed last week. One surprise that we got, and this is the Fed's dot plot. So for those that don't know, the dot plot is the forward-looking plan by the various members of the Fed. And so you can see the dots clustered for 2022 above the 4% mark. And this was largely expected. So most of the Fed participants expect that the rates are going to rise to just above 4, maybe over 4.5%. The surprise came in the fact that for 2023, so for all of that year, all of the participants, bar one, felt that the rate was going to be sitting around 4.5% or higher. And this really rubbed markets up the wrong way. We saw all kinds of extreme action within the equity, within the stock market, the bond market, and in commodity markets. You can see that further out, so through 2024, 25, and beyond, they've got a target rate that they would like to land at, but you can see that there's a bit more of a diverse opinion about where the rate should land, and this reflects the uncertainty of what could happen through the entire of 2023. So this surprise is almost certainly due to the fact that inflation came in hotter than expected in the last reading, and that brings me on to when the Fed might want to pivot. I think that a large part of the market, they don't believe the dot plot at the moment, even though the opinion of the Fed members has become a bit more strong. If you look at the bond market, you can tell that it doesn't entirely believe that rates are going to be this high for this long through next year, but I guess we'll see. So trying to figure out when the Fed might pivot, pivoting meaning that they become more dovish. The Fed starts to favor growth more than a contractionary economic policy. Now this diagram looks a bit complicated, but let me explain it. It's actually very simple. So you can see the actual year-on-year CPI number for the US laid out here through the first part of the diagram in the middle. On the right, we can see the Fed funds rate, the interest rate on the right, and we can see that it's increased aggressively. And then towards the bottom of this diagram, we have the various scenarios that might play out. So each column represents a different scenario where on average, CPI increases not at all, 0 month-on-month, 0.1% month-on-month, all the way through to 0.4% month-on-month. And then what is expected in terms of rate increases by the Fed on the far right of the column. Now the theory here by Elf, Macro Elf, very clever guy, very clued up when it comes to macroeconomics, is that you need to have two things in order for a Fed to pivot. And so you need a sustained path to 2%. So they want to see the inflation dropping significantly and getting pretty close to that 2% rate. And they probably will also want to have the Fed funds higher than CPI for a few quarters. The creator of this diagram has highlighted what they think is the most likely scenario, which is this one outlined in red. And in this case, the Fed starts to pivot somewhere within the Q2, maybe Q3 kind of time range in 2023. Now, leading in to a Fed pivot, the Fed is also likely to start to become a bit more dovish. So we don't know when exactly they'll become more dovish, but let's say it starts happening towards the very tail end of this year, maybe the beginning of next year. The stock market tries to predict the future. And so if they feel as though the Fed is about to start turning, then that's when we'll start seeing the behaviors within the stock market change. And this in turn leads me on to the question that is probably playing on most investors' minds, which is, when are stocks likely to bottom? This is quite an interesting picture, and it's useful to look back on data to see how the markets have behaved historically. And if we do so in 11 out of the last 12 recessions, the SP500 has bottomed before the recession is over. And in fact, stocks have usually bottomed about 6 months before the economy, but have bottomed by as much as 10 months before the economic decline is over. Now, of course, statistics are just that, they're probabilities, but it looks as though the odds are in the favor of the market bottoming before the recession is over, in about 6 months before that recession is over. This does tend to make sense. I mean, the stock market began to fall before all of the signs of economic weakness that we currently have were available. So the stock market correctly forecasted what was coming down the line for the economy. And similarly, it does the same towards the tail end of that part of the cycle. And so going back to this diagram, if the Fed pivots in Q2, Q3 next year, start to become more dovish in Q1 next year, maybe towards the tail end of Q4 this year, then stocks are probably going to start pivoting roughly within that time frame, Q4 of this year, Q1 of next year. Even if this does end up being the case, and this is just an educated guess based on the data that we have right now and historical precedents, most people are likely to be very, very cautious. There have been a few face-ripping bear market rallies in this decline, and every time that happens, the participants in the market become a little bit more wary of those rallies when they happen. At some point, the market will find a bottom and it will rally again, and people will be worried that this is yet another bear market rally, but it won't be. It'll be the rally from the bottom of the market, and it is likely to be quite an aggressive, strong rally based on historical precedents. I do not want to be caught out being on the wrong side of that trade, and that's why my portfolio tends to be predominantly long only. Now, there is still a lot of weakness in the US economy, and I think that it's permeating all the different layers of that economy at the moment. It's most obvious within house sales, and this is because house sales are tied to mortgage rates, and mortgage rates are tied to the interest rate. This means that the effect of rate hikes is very quick when it comes to home sales within the US. However, there are a number of second and third order effects of rate hikes, and even just slower first order effects of the rate hikes that are still becoming apparent within the US economy. And I think that it's going to take the next quarter, maybe two, for these to become apparent throughout the US economy. Now, I take a lot of flack for my long only approach, for my long-term investing approach. There are a lot of investors out there that are fairly new to the markets, and so they haven't been through these cycles before. And being aware of your own psychology and managing your own psychology is just as important as doing all the other hard graft as an investor. You can do your research, your analysis, spend 60 hours a week researching and making sure that you have the right composition of companies within your portfolio, but understanding the way that your brain works and the way that you feel based on current market conditions and managing that is just as important. One of the ways that I manage my own psychology is that I look to fantastic investors, great investors who have styles that are similar to my own. And so on screen, I have the chart for Berkshire Hathaway, a company run by very, very clever people that has an incredibly long track record of great success. These investors that have been in the market for many decades, their companies and their investments experience enormous declines. And the thing that made me want to look at Berkshire Hathaway was I was listening to an interview with Charlie Munger, and he was talking about the fact that the share price of his company had dropped enormously, more than 50% a few times during its existence. But it didn't really bug him, because he thought that this is just part of adult life. If you are going to be someone that's involved in business and in the markets, then a few 50% declines during your investment lifetime are just a price that you pay. the markets go up sometimes, and sometimes they go down. And so in one chart here, we have the proof is in the pudding. A number of gut-wrenching declines in the share price, a fantastic company run by incredibly intelligent people over a number of decades. And yet it was still a fantastic investment over that entire time. Even if you bought at the top of enormous multi-year declines, you still would have turned a decent buck. All right, on to the UK. So the other big news of the week, at least from my perspective, was the budget that was published on Friday. And this had a number of tax cuts and incentives to increase economic activity within the UK. There are a huge number of items that were announced, and they tend to favor probably London a bit more and also wealthy people a little bit more. There wasn't as much support for businesses announced as I thought, although there were increases in tax that have been cancelled. But the big question in international investors' minds was, how the hell are they going to pay for this? At a time when the UK has spent lots of money supporting the people of the country and the economy, and I think they did a decent job of that. They are now cutting taxes and other ways that they generate revenues in order to stimulate that economy even more. It is a very strange plan. I'm not sure if it's going to work in the long term. I think that in the short term, it probably will have the desired effect. But investors have voted in terms of the foreign exchange, and you can see the dollar is strong versus many currencies in the world. There's been a good deal of GBP weakness since that announcement on Friday. So this big fat red candle on Friday was following that announcement. And our Chancellor said yesterday, or maybe the day before that, yesterday, that there were more to come in terms of tax cuts. So the government will be taking on more debt in order to try to stoke the embers of economic growth within the UK. And so you can't see it really here on this chart, but there was, or maybe you can see it here, there was an enormous decline on this particular pair on cable when that was announced, with the pound almost reaching parity with the dollar. It's a bold plan. Will it work? I don't know. Time will tell. The other big news from the week, I mentioned it briefly at the beginning of this video, is the fact that commodities continue to decline. And just about everything was down on the week except for wheat. So wheat and some other food commodities might still be more expensive next year. And this will partially be because of the war in Ukraine, but also because the world has taken a huge knock in terms of fertilizer production. And so crops next year might not be yielding as much as they traditionally can. However, in terms of other commodities, so natural gas definitely heading in the right direction. It is still up 81% year to date, but I think the plans through Europe have brought the price of natural gas sharply down. We can also see that the likes of oil are very much off of their highs from earlier this year. And this will be because the Fed meeting last week has amplified concerns about a recession. If there is a recession, there's going to be a reduction in demand. Reduction in demand means that a lot less stuff is going to be needed around the world, and so commodities tend to drop when that happens. And finally, what about this week? So there are lots of data points coming out this week. I don't think anything that's got the chance to move the market as much as the Fed meeting last week, although we will find out more about the macro picture when it comes to housing within the US in the first part of this week. We're also going to get, I think, the second estimate of Q2 GDP out of the US. If for whatever reason this is a lot weaker than anticipated, then I think that we will see some market moves. And then on Friday, we've got some interesting data out of a few different geographies. So the PMI data out of China, GDP numbers out of the UK, inflation data out of the EU, and this measure of inflation out of the US. All right, that's it for this week. I know that it's a bit grim out there at the moment, but that's just the economic cycle playing out. All right, speak to you soon. Goodbye.